This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 392 was produced on September 7th, 2023. I'm Erik Townsend. Jesse Felder returns as this week's feature interview guest. We'll discuss the many reasons Jesse is questioning the soft landing narrative and expecting more turbulence for the stock market. And I've got a commodity trade I'm pretty excited about, but it's much bigger than I could ever put on myself. It involves ridding the entire planet of nuclear waste and making a considerable profit from doing that. I'm going to lay out the entire trade for you right here on MacroVoices after the feature interview with Jesse Felder.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, September 6, 2023. The S&P 500 futures were down 117 basis points to 44.71. Note that if you are charting the continuous futures contracts, the roll happens into next week from September to December with almost a 50-point difference. So it's just important to note that that is not an actual gap higher in the market. We will take a closer look at that chart and the key technical levels to watch in the postgame segment. The US dollar index up 162 basis points to 104.80, cleared the May highs and is approaching the year highs from January and March. The October WTI crude oil contract up 681 basis points, closing at 87.19. The bulls bought the dip with a vengeance, clearing year highs with next resistance in the 90s. Erik and I will look at that chart in the postgame. The December gold contract down 147 basis points to 1944. The August rally proved simply to be an oversold retracement with the prevailing downtrend still in play. Copper down 130 basis points to 379, remaining in the middle of a 4-month trade range. Uranium up 328 basis points to 61.40, continues trading to new highs for 2023, with the 2022 highs near $64 being the next target. The U.S. 10-year Treasury yield up 16 basis points, closing to 4.28, trading back to year highs, with old traders waiting in suspense if another round of bond carnage is coming. The key news to watch next week is inflation numbers, the ECB press conference, retail sales, Empire State Manufacturing, and the consumer sentiment numbers. This week's feature interview guest is Jesse Felder. Erik, why did we invite Jesse back on as a guest this week?
Well, Patrick, Jesse has been a long-time listener favorite. We had a few requests to get him back on, and it's been more than a year since we had him on the program, so we're overdue.
Well, Erik's interview with Jesse Felder is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Erik Townsend.
Joining me now is Felder Report founder and publisher Jesse Felder. Jesse, it's great to get you back on the show. Listeners, Jesse prepared a slide deck for this week's interview. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you haven't registered yet at macrovoices.com. Just go to our homepage, click the red button above Jesse's picture that says looking for the downloads. Jesse, as we dive into the slide deck on page 1 here, you've got equity valuations and interest rates. Before we even get into that, I want to just start with the real high-level picture that I think is on everybody's mind, which is all the smartest guys said, hey, it's a bear market rally. Don't trust it. It's going to roll back over. The bear market's not over. The bottom is not in yet. Boy, if that's right, this bear market rally sure is pretty long in the tooth. What's going on here? Is something changed, or why are we having this experience where everybody's waiting for the recession and the resumption of the bear market, but it's not happening?
Well, I mean, that's the question that is on everyone's minds, right? Is this a bear market rally? Are we going to have a soft landing? I've been thinking about this idea of a soft landing, and to me, it's pretty astounding. It reminds me of the old joke about the optimist who falls off the top of a skyscraper, and on the way down, as he passes every level, he says to himself, so far, so good, right? Because I haven't hit the bottom yet, that, maybe things are going to work out okay. And I think that's kind of where we are in the cycle, where people are looking and say, well, we don't see a recession, materializing right now in front of our eyes. And so maybe things are going to work out okay. But I think that they are underestimating the impact. It's astounding to me that it's obvious to everybody. Everybody knows that these things work with long and variable lags, monetary policy and the rise in interest rates and all of these things. But we're not willing to wait until those lags actually kick in, which is, right about now. I have a couple of charts in there that's a 24-month lead on a composite of the dollar, interest rates, and oil prices. And, all these kinds of leading indicators suggest that, if a recession is going to happen, it should start to materialize before the end of the year over the next several months. So I still think, we're kind of halfway down, after we've falling off the top of the skyscraper, and we haven't hit ground yet, but we're headed that direction. And so I think, the idea that we're headed for a soft landing is overly optimistic.
I agree with you that it's overly optimistic, but I sure can't explain what's been going on with the equity market. I mean, it just seems like we've got this immunity to what a lot of people agree are some pretty significant macro risks. Any thoughts on why there's really seemingly no reaction to these risks?
Yeah, I think Bridgewater did an interesting podcast about a month ago on the topic of the liquidity hole, which is, a term Greg Jensen used, one of the co-CIOs over there. I think you can kind of see it visually in slide 4 of my chart deck there, which is a chart that we should all be familiar with. This is a kind of an indicator that everybody has been looking at for months now, but it's gone, people have kind of stopped looking at it over the last couple of months thinking it doesn't work. But essentially what Jensen was saying in this podcast is the liquidity hole that Bridgewater expected to materialize at the beginning of the year was delayed due to a couple of things. One, the rescue of the regional banking system, where the Fed had to come in and expand the balance sheet again, kind of undo some of its quantitative tightening. As Stan Druckenmiller said, they undid, about a year's worth of quantitative tightening in a week, which is a big deal. And then you had the issue with, the Treasury general account being run down to next to nothing as a result of the debt ceiling. And those two things created, a positive effect on liquidity over the first half of the year that, was kind of difficult to foresee until we actually got into those things. And so the liquidity hole is now materializing. And just to kind of define that, I think it's the Treasury now needs to, and has already gone a certain distance towards kind of ramping up the general account again, refilling the coffers of the Treasury, but has a ton more debt to sell through year end. And that creates a crowding out effect, and it makes it difficult for other assets to attract capital, which is why interest rates have been going up the last month. And so I think when you look at visually on this slide, it's pretty clear the trend in liquidity didn't continue lower as a lot of people expected this year and actually reversed strongly higher through the spring and into the summer. Now it's reversing again lower, and that's an important dynamic as to why we had such a strong rally through, the first half of this year.
I skipped ahead a little bit. Let's come back to the first page of the slide deck where you're showing equity valuations versus interest rates. I was expecting the blue line to be the S&P 500 price, but you're actually showing something else called the Buffett yardstick. Tell us what that's about.
Yeah, the Buffett yardstick is a metric that Warren Buffett first, I think, wrote about in Fortune magazine back in 2000 at the top of the dot-com mania. You can see that peak there in that 1999-2000 timeframe, where he suggested valuations had reached a level that were totally unsustainable. And you could see that after that peak in 2000, valuations reverted for, over a decade. And essentially, this measures just the total value of the stock market, total market cap relative to the size of the economy. In this case, we're using GDP. I think he's used GNP in the past, but just market cap to GDP. It's basically like a price to sales ratio. And what we've seen over the last few years is we've actually taken out those dot-com mania highs and has had new record highs in terms of valuations on this metric. And that coincided with this period of falling interest rates. And so I think it's, Jeremy Grantham recently said in an interview with Bloomberg, in the end, life is simple. Low rates push up asset prices, higher rates push down asset prices. he went on to say, we're now in an era that will average higher rates than we had for the last 10 years. And we've already seen, right, the 10-year yield go over 4%. And as this chart suggests that, there's a lag effect with valuations. Interest rates go up and it takes time for the valuations to reflect that. And I think that's kind of what we're looking at over the next 18 months is the stock market is maybe starting to now reconcile itself with the fact that interest rates might be higher for longer. And part of that is related to this liquidity hole of, the demands of the Treasury. And if so, it means, valuations probably need to revert back to a more normal level relative to interest rates.
I'm really curious about this blue line on the chart because, as you're saying, this is Buffett's indicator that kind of tells you when the system is in bubble mode, when we've got crazy valuations. And as you say, we saw that in late 1999 going into 2000. There's that big peak there. But as I look at this chart, Jesse, we had obviously a huge peak after the COVID overstimulus reaction to the pandemic. But hey, wait a minute. It's pretty much reverted back down to trend line growth. We're back down to the trend line now. It seems like the fluff is out of the system, at least according to this chart on the blue line. Am I reading that wrong?
Yeah, I think, actually valuations, the only reason I think they've been trending higher for this period of time from 1990 to today is the fact that interest rates were going down. So that's the red dotted line there. It's inverted on the scale there, right? So back in 1990, the 10-year yield was, 8+%. And it's fallen to almost zero, at the peak of the pandemic bubble in 2021, which helped to support, the record high valuations. But if you believe that, I don't even think you have to believe that interest rates have made, a secular low and are now going to trend higher. Just the fact that they've gone from 50 basis points on the 10-year to over 4% today suggests that equities are significantly out of line in terms of risk-free rates. So, another way to look at this is if you look at just the stock-to-bond ratio, just take a simple ratio of SPY to TLT on a monthly time frame and on a quarterly time frame. Stocks have never been more overbought in terms of relative strength. Never been more overbought relative to bonds than they are today. So all that means is TLT has been hammered, right? Bonds have been hammered over the last year and a half, and stocks have not. And usually they kind of trade in a range with each other. The risk-free rate goes up. Valuations have to come down. And I think that's where we're headed over the next 18 months or so is the stock market starting to reflect a sustainably higher discount rate.
On page 2, you're showing a macro earnings model. What's the model and what are these two indicators or these two lines on the chart telling us?
The way equity investors could be right and valuations remain elevated as they are today is if we did get a soft landing in the economy, right? If we had, we avoid recession, inflation comes down sustainably in a way that allows the Fed to lower interest rates significantly. And for both of those things to happen, I think most people believe that, that's kind of threading the needle in a way that we've probably never seen a central bank accomplish before. That, in order to bring inflation down sustainably, we need a recession. And so what this next slide represents is a leading indicator for corporate earnings. Right? It's basically just a 2-year lead of the 10-year Treasury yield, the oil price, and the dollar index. And you can see that this composite of leading indicators does a very good job of telling you where corporate earnings are going over the next 2 years. And so what we've seen is, you could see back in the 2021-22 timeframe, we had a terrific surge in earnings. And that was absolutely perfectly forecast by the dramatic drop in interest rates, oil prices, and the dollar in reaction to the onset of COVID. But now that those have reversed and we've seen a strong rise in interest rates, oil prices, and the dollar, it suggests that over the next year or two, earnings are going to come under a great deal of pressure. Now, this is a really good leading indicator, not just for corporate earnings, but for economic activity, for ISM. I've seen it used for ISM and other things. And so it suggests that the idea of a soft landing is, as I said, overly optimistic, just because what we've seen in terms of the economic headwinds as a result of these leading indicators are so significant that we're very likely to see a significant decline in economic activity and earnings over the next several quarters.
Now, Jesse, I agree with what you just said, and I think we are headed back towards secular inflation. But for the sake of doing my journalistic job here, let's channel our friend Alex Gurevich, who I'm sure if he were listening to this would say, wait a minute, Jesse, you're missing the story here. Look at that red line. It bottomed down there, and that was all COVID, stuff that caused this exogenous event on interest rates. And you're seeing the beginnings now of a recovery and probably, a little bit of a pullback on that recovery. This is your opportunity to buy bonds here because we're headed not just to zero interest rates, but we're going negative interest rates. It's all coming. How would you react to that view? Because, Alex has a pretty good point and he's made some pretty good calls.
Yeah, no, I absolutely agree. I think right now, traditionally, as a macro investor, if you thought we were headed for a hard landing, it would be time to buy bonds, right? Interest rates are going to come down because the Fed is going to have to respond to rising unemployment and these things, and it's going to have to focus on that side of the mandate because inflation's going to not be a problem because the economy is going to go in the toilet. I think what makes this cycle uniquely difficult is that there's that supply-demand dynamic in the Treasury market. Bill Dudley has been warning about, former head of the New York Fed, and Ray Dalio. These are two people who understand the workings of these markets better than 99% of people on the planet. And when they say, Bill Dudley's been warning for the entire year, he'd be surprised if we don't see turbulence in the Treasury market at some point this year, simply due to supply-demand dynamics, that the Treasury has so much debt to sell, and the demand for it is waning, right? Fed's not a buyer anymore. Fed's doing quantitative tightening. Foreign central banks have been reducing their appetite for treasuries. Who's going to buy all this debt? And I think that's, when we look at the technical, just look at the chart of the 10-year yield. To me, it looks like we've seen a bullish flag pattern since the October high, and we're now testing that high again. And if it breaks out higher, we could be heading to 5%. And to me, when I look at the technicals and they validate what I see in terms of just the supply-demand issue and what people like Bill Dudley and Ray Dalio have been warning about, I don't necessarily want to step in front of that issuance freight train that the Treasury's kind of embarking on right now.
Jesse, page 3 is titled Financial Shenanigans in the Economy. I don't doubt that there's any financial shenanigans in the economy, but why don't you tell us exactly what the blue line really tells us on the chart here?
Yeah, so this is, I said corporate earnings look like they're headed for recessionary territory. And in fact, that slide on chart 2 suggests that, the decline in earnings, the potential for a decline in earnings is as great as anything we've seen in the last 3 decades. This next chart suggests that we already see this materializing in S&P 500 earnings. So basically, this chart shows the ratio between the S&P 500 reporting earnings and NIPA profits as reported by the Bureau of Economic Analysis. And when these two, I stole this chart from Charles Gav, who's pointed out when you see this huge divergence between the two, between S&P 500 earnings and earnings reported by the BEA, it's always a sign of recession, right? Right now, there's a 40% gap. We saw that in 2020. We saw it in 2009. We saw it in 2001. We saw this in 1974 and in 1980. Every time we've seen such a big gap between S&P 500 earnings and NIPA profits like this, we're either very close to recession or we're already in recession. And so what does this mean? Essentially, it means that S&P 500 companies are doing everything in their power as earnings are starting to roll over and decline to make them look better than they really are. For example, Google in its first quarter report extended the usable life of its server infrastructure to 6 years from 4 years. So, that reduces the depreciation, that they're running through the earnings statement and increases earnings. And so when you look at a number of companies doing these types of things on a grand scale, it suggests that profits are inflated in a way that is totally unsustainable. And it's usually companies trying to stretch out as much profit as they can and make things look as good as they can before they finally have to give in and start reflecting the true trend in earnings, which is significantly lower.
We touched on slide 4 earlier, but I want to come back to it because the title, Don't Fight the Fed, is probably the most respected wisdom there is in markets. But look at this chart, Jesse. The S&P, the blue line, is clearly fighting the Fed and seems to be winning. What's going on?
Well, I think it is this soft landing narrative, right? Everybody's thinking that the Fed has won the fight with inflation and the economy is going to avoid recession, and so allowing the Fed to lower interest rates. As I said, I think those were probably wrong on both sides of that narrative. That cyclically inflation is coming down, yes, but longer-term inflation dynamics, I don't think there's any sign the Fed has sustainably brought them back down below target. And there are tons of signs suggesting that recession, if it's not here already, is coming in the fourth quarter. So I think that, the market is fighting the Fed. It did so, August a year ago, right? And immediately reversed lower. Now, it hasn't done so as quickly this time. But I do think with this liquidity hole materializing, which is, I think, what this chart starts to show, and it actually doesn't even show the real effect that Bridgewater's kind of referring to. This just shows Fed's quantitative tightening. The forecast in the red line that goes forward from today is just the communicated quantitative tightening the Fed has already said it's going to do. It doesn't include any increase in the TGA or increased Treasury issuance or anything like that. So if you get that massive increase in Treasury issuance on top of the quantitative tightening, this picture is even more negative than the chart represents.
Moving on to page 5, we've got the stocks and speculators chart. What's going on here?
This is, to me, the best visual evidence that traders have gone all in on the soft landing narrative. This is essentially just the S&P 500 commitment of traders report on S&P 500 futures, and it's the small speculators within that report. They're very, very often a good contrarian indicator. You can see in the early days of the pandemic, they were significantly net short, $20 billion of nominal futures. And that's really what helped the rally in 2020 and 2021 is everybody who was far too bearish on the stock market had to reverse and cover their shorts, and that powered the really strong move higher. But you saw in 2021, these traders got massively long, right? Prior to this, they'd never gone long, more than $20 billion in futures. They got over $40 billion long in 2021. And so realizing they'd gotten too bullish in the bear market of last year, had to unwind those positions. That created, helped fuel the sell-off last year. But even, you asked, how did the market rally so strongly over the last few months? Well, small speculators here again got massively bearish, over the last several months. They were net short $40 billion worth of futures. And I think this is not just, small speculators moving the market. I'm not suggesting that, but I'm just suggesting that this is representative of equity market sentiment in a broader sense. And so the fact that they've gone recently almost 40 billion net long again for the first time since 2021 suggests to me that stock market speculators, investors, traders, retail have all gone all in on the soft landing narrative. And so to the extent that that narrative starts to be questioned and the data starts to potentially undermine that narrative, there's going to be a potentially big unwind in positioning of people who've gotten far too bullish.
Jesse, tell me about the chasing growth chart on page 6.
Yeah, well, this is a price analog, and I can't remember where I found this. I wish I could give credit where it's due here, but this is essentially just the S&P 500 growth index from 1997 to 2003. That's the red dotted line, and from 2019 to today. And you can see that, obviously, if you thought, 2001, 99, 2000 was a bubble that burst, you can see kind of, as my friend Tom McClellan would say, the dance moves are pretty well in line with each other here. It's maybe not a perfect price analog, But you can see how bubbles unwind, right? It's not a straight line where they go straight up and then straight down. And so this bear market rally that we've seen this year, rhymes pretty well. There was a similar dance step, in the early 2001, 2002 timeframe before that dot-com bust had fully run its course. And so I think it's interesting to me that you see, the 1998 sell-off lines up very nicely with the 2020 COVID crash. And so there are patterns that kind of govern these things. Price analog is not the be-all, end-all of investment analysis by any stretch of the imagination. But I think it's just evidence that you can have massive rallies and still be in a bear market. And that's exactly what we saw during the dot-com bust 20 years ago.
On page 7, your title is The Magnificent Seven, and I don't know what you're going to tell us about these stocks, but I can't help but observe from the list here that it seems to be the same stocks that most people under 30 years old believe are impossible to go down other than in the shortest time frames. What could go wrong here?
Basically, this chart just shows the valuation of these. I've basically just aggregated their market cap. Let's just add all their market cap together and, multiple trillions of dollars, and then aggregate all of their free cash flow, right? And see what is the multiple. What is the multiple of these 7 stocks? Because this is, I think they're 25% of the S&P 500 now and 50% of the NASDAQ 100. So, they have a huge, the strength in these stock prices has driven the broad market higher this year. And there's been a ton of people have pointed this out. I'm not the first by any stretch. But the fact that these stocks now trade as a group 60 times their free cash flow suggests to me that, they are very vulnerable to a hard landing in the economy. You look at over the last 10 years, the average valuation that they've traded at is about 30 times free cash flow. So they trade twice their 10-year historical valuation. So part of this is, we should talk about the dynamics here. Part of this is the fact that, they've been spending so heavily, especially companies like Microsoft and Alphabet, massively spending on this AI infrastructure in building out these large language models and things. And that capital expenditure starts to eat into free cash flow, right? Free cash flow is just operating cash flow, less capital expenditures. And so the fact that these companies are slowing top-line revenue growth, they've all seen their top-line revenue growth slow. And now they're spending tons of money to keep up in this AI arms race, suggests their profitability is declining. And it's probably not a great time to want to invest in these types of stocks when they trade at such obscene multiples. Now, if the top line growth continues to decline, as I think it will into a recession, profitability could suffer dramatically, in terms of a free cash flow here. That suggests that there's a potential for a significant reversion in valuations in these stocks. And the fact that there's such a big part of the broad market suggests that everybody who owns, S&P 500 or any other of the major indexes is, vulnerable to this type of a reversion in valuations here.
Well, Jesse, I can't thank you enough for a terrific interview. But before I let you go, please tell us more about what you do at the Felder Report and where people who have not discovered your newsletter can find out more about it.
Well, this chart deck I took just from a monthly chart book I put together for premium subscribers to the Felder Report. That's just one of the reports I put out regularly. I put out a weekly market comment. It's basically just kind of a recap of themes that I'm tracking, narratives in the markets that I think are driving asset prices. And it can be anything from, what's driving Chinese equities to inflation to, the soft landing narrative. And I put out the market comment. I write for a weekly chart book for pro subscribers and trade ideas, so individual equities ideas. And so that, and then at thefelderreport.com, I put out a weekly free blog post that just kind of highlights some of the 5 most interesting things I found during the week. And so you can sign up for that right on the homepage.
And that's all at thefelderreport.com. Patrick Ceresna and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Okay, Erik, at the top of the show, you teased our listeners about talking about some really big commodity trade that you've been speculating about. What's on your mind?
I'm going to make a case for recycling all of the high-level nuclear waste in existence and making a considerable profit from that undertaking. Now, to pull this off, you have to be able to negotiate directly with major governments and form treaties to take their spent nuclear fuel waste off their hands. So, obviously, this isn't something that retail traders can do in listed markets. Let's start with the basic facts. There's about 250,000 metric tons of high-level nuclear waste in storage around the world. Almost all of it is spent fuel rods from civilian power reactors. 95% of that spent fuel waste is perfectly good uranium that can and should be recycled in order to make new fuel rods to fuel tomorrow's reactors. The total amount of uranium that we could recover is about 237 metric tons, or about $26 billion worth at today's market price. Now let's start with the simplest form of this trade, which plenty of people before me have analyzed. If you're trying to justify this undertaking by assuming that you're going to use the money you sell the recycled uranium for in order to pay for the expense of reprocessing, well, that's a good idea, but the trade only becomes economic with uranium prices over $600 per pound, or approximately 10 times the current market price. In other words, it's nowhere close to profitable if your only cash inflow is going to be selling the recycled uranium, which is the way most people have looked at this trade. But I contend that if you put yourself in the shoes of the current holders of that spent fuel waste, they're forced to pay to store that waste indefinitely. And the storage costs are considerable. So my hypothesis is that any reasonable holder of spent nuclear fuel waste ought to be easily persuaded to pay the equivalent of several years' storage expenses in order to safely and responsibly get rid of that waste forever, get it off their hands so they don't have to worry about it ever again. And what shocked me, Patrick, was when I ran the cocktail napkin numbers and concluded that you really only need about 4 years of storage costs from the present holder of the waste in order to break even on this trade. If you can get them to pay you 5 years worth of storage costs just to take that waste off their hands, then it makes a nice profit. And if you could get them to pay just 10 lousy years of storage, and remember, their alternative is to keep storing that waste for hundreds or thousands of years. But if you could get them to agree to just pay 10 years worth of storage to get rid of that waste, you could make an obscene profit on this trade. Is it really that difficult of a sale when you say to the current holder of nuclear waste who expects to store that waste for hundreds of years that they could be done and over with it for once and for all for just 10 years worth of storage fees? Now stop and consider who you have to be in order to pull this trade off in the first place. You've got to be able to negotiate nuclear waste deals with entire nations. So you either have to be a sovereign government yourself, or you have to be Goldman Sachs, who has more high-level government contacts around the world than any government has. Now think about the PR value of ridding the world of nuclear waste. For the record, nuclear waste isn't actually anywhere close to as dangerous as people think it is, but that's beside the point. People think that nuclear waste is a really big deal. So if you're a country like Saudi Arabia or United Arab Emirates that's already trying to establish itself as a leader in energy long beyond the age of oil, what could possibly be better PR than to have MBS waltz into the United Nations and tell the General Assembly, okay, look guys, we're Saudi Arabia and we're going to do a good deed by ridding the entire world of all nuclear waste. Just because we can, we're Saudi Arabia, we're a long-term leader in the energy market globally, and that's just how we roll. So they upstage the West and do what Western governments have failed to do and get rid of all the nuclear waste. They say, hey, look, just send us all of your nuclear waste along with 10 years worth of storage fees, and we'll get rid of it for you. Then they buy up all the waste around the world, build some reprocessing plants, or just acquire Uranium in France, and then be sure to get plenty of TV cameras on site when they start reprocessing waste for other countries. Now, of course, not all governments would cooperate, and some would reprocess their own waste to maintain control. But that doesn't matter. From a PR perspective, whoever was the first politician on the global stage to declare that he was going to solve the nuclear waste problem for once and for all that guy is going to be a hero in the public's eye, regardless of what actually happens, and regardless of who ultimately winds up reprocessing that waste. And if they acquire Orano and the other reprocessors first, then the guys putting on this trade are sure to get paid for reprocessing, regardless of who contracts for that reprocessing. So if you're the Goldman in this story, you figure out who stands to gain the most politically from the PR stunt of solving the nuclear waste problem for the entire planet. And then you set the deal up so that head of state gets all the PR value and Goldman keeps all the profits for managing the reprocessing operation for themselves, as they always do. And for the right sovereign actor, this could be a PR goldmine.
That seems a little too easy. You already said the trade doesn't break even until $600 uranium unless the current holders of the waste are willing to pay you for several years of storage expense to take it off their hands. Surely someone else thought of this angle before, but wasn't able to get anyone to pay up to get rid of the waste. Am I missing something here?
This is a critical aspect of my trade hypothesis. There's a good reason that the current holders of spent nuclear fuel waste would reject the very assertion that recycling achieves the goal of getting rid of that waste, because as of now, it really doesn't achieve that goal. When you reprocess spent fuel waste, you recover the 95% that's perfectly good natural uranium. But the remaining 5% is some really nasty stuff called fission byproducts and transuranics. So in effect, reprocessing nuclear waste doesn't make the waste go away. It separates that cold cup of coffee we call nuclear waste into one cup of pure clean water and one small shot of concentrated nuclear espresso. So for the operator of this trade to claim that they've solved the waste problem by reprocessing all the waste would cause anti-nuclear activists to call foul, and rightly so. Reprocessing doesn't get rid of the nastiest nuclear waste. All it does is separate the 95%, which is perfectly good natural uranium, and concentrate the rest into about 1/20th of its present weight and volume. But all the bad stuff is still in that 5% that remains after the spent fuel waste was reprocessed. But wait, it gets even worse. Among other things, that 5% of nuclear waste espresso that I'm talking about contains some plutonium. Yep, that's right. The stuff they make nuclear bombs with is contained in that waste. So when you reprocess uranium, you concentrate the worst of the waste in the process. And it can be argued that you measurably increased nuclear weapons proliferation risk by doing so. The primary reason that civilian nuclear power is perceived as a weapons proliferation risk is that with enough work, it's theoretically possible to extract enough plutonium from the waste to make a nuclear bomb with. And India actually did that using a repurposed Canadian power reactor back in the 1950s. Now, it takes a lot of effort to separate the plutonium from the rest of the waste, but removing all the uranium and concentrating the remaining waste 20 times just means that if we recycled all the waste in existence, who's ever in possession of the remaining 13 metric tons still has all the plutonium that was previously diluted in the original 250,000 metric tons of waste, which is now in storage. But it would be concentrated 20 times into those 13 metric tons. So I contend that to persuade the current holders of spent fuel waste to be willing to pay you 10 years' worth of storage just to take it off their hands, all you should need to do is be able to prove to their satisfaction that you really do have a credible plan to make that waste truly go away, not concentrate it into nuclear espresso, but truly eliminate it from existence. Now remember, my whole hypothesis is that the best actor to put this trade on is a sovereign government like Saudi Arabia or United Arab Emirates, who already has a vested interest in establishing itself as a leader in the nuclear energy industry. Now, with that context, this trade really starts to get interesting. One of the most exciting advanced nuclear technologies that will be explained in Episode 6 of my soon-to-be-released docuseries on energy transition is called a burner reactor. It's a close cousin to a breeder reactor, which is also explained in that episode. But a burner reactor is a special kind of nuclear reactor that can actually burn that last 5% of nuclear waste espresso and consume it as fuel to make electricity with. So the real play here for Saudi Arabia or United Arab Emirates is to do both at once. First, you acquire all the advanced nuclear companies that are building waste-burning reactor prototypes right now. And yes, there are startup companies building waste-burning reactor prototypes right now as we speak, and for full disclosure, I even own a piece of one of them. But my point is, once you're building and operating waste-burning reactors, you have a bona fide way to assure the present holders of nuclear waste that if they're willing to pay you just 10 years of storage fees, you really can safely dispose of that waste for them for good. Not just concentrate it and recover the uranium, but truly dispose of the nastiest 5% of nuclear espresso so that it literally does not exist anymore. I contend that any reasonable party would take that deal if you can persuade them that you really and truly do have the capability of burning up and disposing of that waste completely. And with 10 years of storage fees, this trade makes an insane profit. You could easily recover the cost of acquiring the companies you need to acquire in order to do it. Now, a U.S. actor could never pull this off. Burner reactors are so far beyond what the Nuclear Regulatory Commission knows how to regulate that you could never get government authorization to actually turn one of these things on. But if you're a sovereign government like Saudi Arabia or United Arab Emirates, you just hire the best nuclear regulators and start your own NRC, and then you fast-track the waste-burning reactor industry without all the bullshit and red tape that would prevent the U.S. government from doing it in anything less than 20 years' time. There are guys out there right now building prototypes of these burner reactors, right here, right now in 2023. You hire them by acquiring them, and you seduce them into the acquisition by offering them a cooperative jurisdiction to test and develop their advanced nuclear products that the West has been extremely slow to appreciate the strategic value of and to permit. And once you've acquired all the companies building burner reactors, you can realistically sell the idea that I'm describing to the present holders of nuclear fuel waste. And it's a whole new proposition. You really are proposing to dispose of that waste, not to concentrate it, but to dispose of it for once and for all.
Aren't both Saudi Arabia and the UAE already running programs where they're trying to establish themselves as global leaders in nuclear energy?
I should confess that I'm only just starting to learn about both of those countries' nuclear programs. But to be honest, from what I've seen so far, I really have to wonder who's advising them and what the heck they're thinking. Again, please forgive me, folks, if I have these details wrong. I'm just starting to come up to speed on the nuclear aspirations of Middle Eastern oil exporting nations, and I probably don't have all of my facts straight yet. I'll do my best to tell you what I know based on what I know so far. The first part of this makes perfect sense. Both Saudi Arabia and United Arab Emirates have already made announcements that their intention is to remain global leaders in the energy business long after the age of oil winds down. And therefore, they're already making investments now to establish themselves as leaders in nuclear energy. So far, so good. I couldn't possibly imagine a better strategy for them to adopt, and I firmly believe that control of the small modular reactor industry that doesn't even exist yet is going to determine the course of world history, and specifically the phenomenon that the Middle East enjoyed, where oil made them just fabulously wealthy, is going to be repeated in that SMR industry. So whoever controls that is going to define the future of energy on this planet. That's definitely where any country that views energy as its strategic future has to be. And I'll have more on that subject in episode 7 of my docuseries, which will be released later this month on the MacroVoices YouTube channel. So when I heard that Saudi Arabia intends to be a leader in nuclear, my first thought was that MBS is right on top of this. He gets it, he sees the big picture, and he knows how to keep his country on top of the global economy by using the money they already made from oil to establish themselves as leaders in advanced nuclear energy. Brilliant, perfect strategy, and they have an incredible opportunity right now to literally acquire the entire advanced nuclear industry for a price they can easily afford to pay. So that's what I assumed they were talking about when they said they wanted to invest in becoming a leader in nuclear energy. I figured MBS is a smart guy who surely has figured out by now that one of the biggest problems with conventional uranium-fueled, water-cooled nuclear reactors is that you need a large ocean or river to build one of these silly things because of the cooling water demands that they have. So I figured MBS has to be all over molten salt reactors. That's the kind of reactor that you can operate in the desert without a river or an ocean nearby to supply cleaning water. That would be the obvious and logical place for Saudi Arabia to really establish itself with a controlling interest in what I think will be the most important formative new industry of the 21st century. And they could easily afford to acquire every single important company in that field tomorrow morning if they wanted to. But then I dig a little deeper and learned that MBS's plan to establish Saudi Arabia as a nuclear leader is to hire the South Koreans to build him an old-school, once-through, light-water moderated, uranium-fueled reactor. Okay, now I'm confused. First, I thought Saudi Arabia had an utterly brilliant strategy to establish itself as leaders in a formative new industry that will determine the future of energy. That's what they should be doing. I thought that's what they said they were going to be doing. But instead, they're hiring South Koreans to build them a shiny, brand new example of the exact technology that needs to be replaced in order to really get the nuclear renaissance on track. Now, all that I know is what I can find on Google. But in my opinion, if all that Saudi Arabia and United Arab Emirates are actually doing in this space right now is just building Korean light water reactors because they can afford to buy one, well, that's like saying you want to get into the publishing business, so you're going to start by buying yourself a subscription to Playboy. That's not being in the publishing business. That's just being a consumer of pornography. And building an old-school uranium-fueled, light-water-moderated nuclear power plant in Saudi Arabia is not equivalent to getting into the nuclear business in any meaningful way. That's just consuming the old-guard nuclear industry's failing and antiquated products. For what reason, I'm not even certain. Now, don't get me wrong. If I wanted to build an old-school conventional nuclear power plant, I would hire the South Koreans in a heartbeat long before I would give that business to Westinghouse. So in terms of choosing the right vendor to build his old-school, dated technology nuclear power plant, MBS definitely chose the right people. But the question I'm left with is why in the world MBS would think that building an old-school nuclear plant in Saudi Arabia has anything to do with getting Saudi Arabia into the business of being a leader in advanced nuclear energy technology. To do that would require completely different actions, which I don't see Saudi Arabia or United Arab Emirates taking, at least not yet. Whether that means they don't get it yet or it just means that they're taking their time before making their important moves isn't really clear. But so far, they're not doing any of the things I think they need to do in order to achieve their stated goals. And I can't say this strongly enough. If there's anything I've learned from spending almost a year on this docuseries project, it's that what's really needed to accomplish energy transition by 2050 is at least 10 times more challenging than all of these COP conference idiots even understand. Ramping up a small modular reactor industry based on Generation 4 advanced nuclear technologies is an utterly massive undertaking. It's so big that it's on the scale of trying to build the biggest building in the world out in the middle of the desert where you don't even have anything but soft sand, so it's not even possible to build a foundation. Well, it seems to me that the same folks that figured out how to build the Burj Khalifa are rather better financed than the American National Reactor Innovation Center. So if you wanted to leapfrog everything going on in pressurized water SMRs across the world by beating everyone else to market with the first molten salt SMRs, the way to do that would be to acquire the various companies like Copenhagen Atomics, Seaborg, Thorcon, and all the rest who are doing exciting things with advanced nuclear technology. In finance terms, think of it as a roll-up of the best advanced nuclear startups into a single entity that pools all the engineering talent of those former competitors to work together in a concerted effort to supply the world with enough Generation 4 SMRs to solve energy transition, while making a profit eliminating all the world's nuclear waste in the process. Patrick, the total market cap of all of the most interesting advanced nuclear startups combined is only a few $1 billion. The Arabs spend that on sporting goods in a good year. They could literally own the entire advanced nuclear industry and cement their role as the long-term supplier of energy to planet Earth if they wanted to. But instead, they're building old-school light water reactors in the desert, where molten salt reactors shine best. That doesn't make any sense. I don't get it. But again, I want to stress that I am not expert on Saudi Arabia or United Arab Emirates plans, and all I know is what I read online. But quite frankly, if someone who actually knows of what they speak is advising them, they've been very slow to act on that advice so far. At least that's my opinion. I'll be in UAE on holiday in early October. So MBZ and MBS, if you guys are listening this week, let's do lunch in Dubai in October, and I'll give you a free brain dump on what I think you ought to be doing in order to seize control of entire industry segments that will define the future of nuclear energy. Building more old-school light water reactors from South Korea won't be on the agenda. We need to talk about molten salt reactors, the kind that work in the desert without needing an ocean or a major river. That's the technology to focus on if you want to truly lead the coming nuclear renaissance.
On the off chance that MBS or MBZ should happen to miss this week's episode of Macro Voices, is there any way for your trade idea to come to life without them?
Saudi Arabia and United Arab Emirates are the obvious actors to make this happen. But I think there's a lot to be said just for getting the basic idea on the table so that everybody knows about it. Most professional investors know that there's a futures trade called a crack spread that allows a trader to almost perfectly recreate financial profits of an oil refinery. Now, in my experience, that trade actually gets used by traders less often than it gets used at cocktail parties, because at cocktail parties, people explaining that trade sound smarter than they really are. So if there's one thing that I want to accomplish by doing this segment on Macro Voices this week, it's to seed the finance industry with a new bit of cocktail party trivia to impress others with your knowledge. Specifically, I want to make everyone in finance aware of the fact that nuclear fuel waste can and should be eliminated completely. And doing that is as simple as contracting the French company Orano to reprocess your waste for you and then burning the remaining concentrated waste in a waste burner reactor. The only reason the private sector hasn't already stepped in and solved this problem where governments have failed is because to make this trade economic, you either need uranium prices over $600 or you need to persuade the supplier of the waste to pay you several years' storage fee to take it off their hands. And that last bit is a really tough sell unless you already own a working burner reactor, something nobody on Earth has right now, but which several smart guys already know how to build, and a few are already actually building. Acquiring those companies and fast-tracking construction of the first burner reactors is the key to being able to sell the present holders of nuclear waste on the idea that you truly have the ability to get rid of it. For a fee, of course. If everyone listening to this podcast, and particularly those of you in professional finance, simply take this story and tell it at your own cocktail parties, before long the word will be out and everyone will know what's possible. And you'll be much more entertaining than the guy cracking the joke for the 14,000th time about his colleague predicting 6 of the last 2 recessions. Once the word is out, it's just a matter of time until somebody at Goldman steals the idea, decides which politician they're going to pitch the PR value to, while Goldman keeps all the profits for themselves.
Are there any other reasons not to recycle all of the nuclear waste in existence?
Just about anyone who's recognized as an expert on nuclear energy or nuclear waste is going to voice a loud objection saying that my whole proposal is completely silly and stupid, because there is no real serious problem with nuclear waste to start with. It's just not anywhere close to as dangerous as the public perceives it to be, and the experts are right about that part. And to be clear, I couldn't possibly be more disappointed in my nuclear expert friends' inability to perceive the obvious. So let me lay the facts of life out for you nuclear experts who think this is all a pointless waste just because nuclear waste isn't really all that dangerous to start with. Look, we have a completely dysfunctional nuclear industry precisely because of irrational fears held by the public. The fact those fears may not be rational isn't relevant, and frankly, I find it tiring when supposed experts seem to have difficulty grasping the simple concept that we need to make nuclear waste go away for the simple reason that hysterical people who don't understand it are going to stay hysterical and scared until something changes. If you make the waste go away and you can tell them it doesn't exist anymore, they will calm down. But until you actually get rid of the waste, they're going to be convinced with all of their hysteria that it's a bigger problem than it is. That's why we need to get rid of the waste, because the public has already convinced themselves that it's bad and they're not going to change their opinion this late in the game. The available options are to keep storing that waste and have the public remain irrationally obsessed with fear about waste, or we can get rid of the waste for once and for all so that we can honestly tell the public that the problem has been completely solved and all of the waste is now scheduled to be reprocessed and then consumed in burner reactors. Yes, it's a PR problem, not an engineering problem. And for the record, engineers, PR problems are generally much more important than engineering problems. The solution to this very important PR problem is to make the waste go away so that the public can't fear it anymore. Engineers should not focus their engineering talents on perseverating over why they don't think it's a problem. They should focus their engineering talents on solving this very real problem. We talked about waste disposal today, and the other two big objections to nuclear, which are meltdowns and weapons proliferation risk, will be addressed in episodes 5, 6, and 7 of my upcoming docuseries.
All kidding aside, are you really going to be in Dubai in October? And are you serious about wanting to pitch this idea to people like MBZ and MBS while you're there?
Indeed, I will be in Dubai in early October, and while I have no fantasies of MBS or MBZ dropping what they're doing to come meet with me, I do believe in the power of the podcast. We know for a fact that we've had OPEC oil ministers listening to MacroVoices in the past when their buddy Dr. Anas Al-Haji was featured in our crude oil special several years ago. So we're only 1 or 2 steps removed between our audience and the people in power. And besides, MBS and MBZ are the wrong people anyway. They would never meet with me because I don't have any formal credentials in this field. And besides, my pitch would be too technical and detailed for them. The real power over there lies with the money interests, and the governments seem to just serve their interests. I'm not even persuaded that the governments themselves are the ones making the final decisions in the Arab world. So obviously, I'd love to be involved in this deal myself if I can find a way to get my fingers into it. But even if I never see any part of this, even if Goldman Sachs just steals my ideas and takes credit for them themselves and I never make a penny off it, I'll still be telling myself that I was the guy who came up with the idea that solved the nuclear waste problem. Of course, the gentlemanly thing to do, Goldmanites, would be to hire me as an advisor. But gentlemen in the finance industry have become scarcer than heavy elements, so I won't expect anything more than bragging rights if someone decides to carry this idea forward without me.
Alrighty then, Erik and I will be back for a post-game segment as MacroVoices continues right here at MacroVoices.com. Erik, it was great to have Jesse Felder back on the show. Nick Galarnik remains on vacation. So Erik, let's talk some charts. Listeners, you're going to find a download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jesse's picture saying, looking for the downloads. All right, Erik, starting on page 2, I have that chart on crude oil. What are you thinking here?
EIA inventory data was delayed this week by the holiday, so we don't have it for you. But the big news this week was Saudi Arabia and Russia extending their production cuts 3 more months. The strong message here is they're not satisfied even at $90 crude. Every dip has been shallower than expected, and the trend is very strongly up. There could still be another shoe left to drop in the form of a recession, further weakening demand. But aside from that, all indications are that the bull market is on in crude.
Yeah, Erik, I know you were looking for that 77 dip on the downside, but the entire consolidation oil did in August was a classic retracement of a bull advance. and it bullishly broke out, and this truly followed through. And like you were saying, the news coming from Saudi Arabia and Russia gave that extra fuel for this breakout. At this stage, I think that the realistic upside targets remain in the mid 90s with some retracement zones that are all the way up at 100. And while it may take a while for us to see a really robust bull market in oil start, I think some more upside here is certainly possible. On page 3, I have that S&P futures chart. And the S&P 500 came to a pretty critical level near this 4,500 level, where it was really, in my mind, a break it or make it moment for the bulls to see whether or not they can go and retest those 2021-22 highs up near 4,800. For me, this is going to continue to be a key pivot area. Market breadth continues to deteriorate. Only a few FANG stocks are holding up. A lot of things are starting to roll over. We're going to watch very closely if the S&P, for whatever reasons, breaks down below this 44.5 level with momentum and challenges those lows from a couple weeks ago. That could really spark a distribution cycle that could do a retracement all the way back towards 4,200. Now, will that be the big bear decline? I don't think so. I think that this simply could just be a deeper, longer correction, but it would start to increase the likelihood that we've already seen the highs of the year. Now, that's not yet confirmed, but this is why we're at such an important juncture in the markets. We're going to see whether or not that technical breakdown actually happens. Moving on to page 4, we have that dollar index. What are you thinking here of the dollar?
We have a breakout in process above 104, which is incredibly significant if it's confirmed, because 104 has been a key level in this market for the last several years. But we need to see the Dixie stay above 104 for a few days to confirm the breakout that appears to be in process as we're going to press. Assuming that it's confirmed, this brings Brent Johnson's forecast of a retest of the recent highs at 115 into question.
Yeah, 104 is generally important, but earlier in the year, we were testing levels just north of 105. So to me, this is not yet a clearing of all bullish ahead here. I still think that there's some overhead resistance that can certainly cause the dollar to bump its head. But I think what is the most noteworthy part is when you break it down to the components. The chart on the euro looks incredibly weak. You see deterioration in the pound. The US dollar yen continues to break out. The US dollar against the renminbi is moving. The Canadian dollar is weak. The Australian dollar is breaking down. There literally is no currency that is fighting this trend now. And so this creates a backdrop where, if the US dollar can hold in here and the bulls are accumulating, a breakout above these resistance levels could really drive a move. And usually in a period where the US dollar is strong, it often triggers risk off periods in risk assets. And so the question here is this dollar going to signal something in the coming weeks and months going into the fourth quarter? It's certainly something that's on my mind. Nonetheless, on page 5, I just wanted to touch on that uranium chart. This is the Sprott Physical Uranium Trust. It has broken its 2022 highs, while the U308 contract has not. I think that's largely because this is priced in Canadian dollars, and it's probably some currency factors that to normalize it. But the point here is uranium does look very bullish and continues to be the strongest commodity market out there. So it'll be interesting to see whether this can continue. So moving on to page 6, we have gold. What are you thinking here, Erik?
Gold is rolling over here predictably as the dollar strengthens. My outlook is for inflation to persist and for the Fed to continue hiking rates longer than most people can believe possible. During that phase, there's no real reason to expect new all-time highs, and I won't be surprised if the market drifts considerably farther lower from here. But eventually, the Fed will break something and be forced to cut rates as inflation continues to run rampant. And that's when gold will really shine. The ride from 2,100 to 2,500 is likely to be a short one, but the ride from here to 2,100 will probably take longer. For now, I think gold will continue to muddle along until there's a clear change of Fed policy, and I don't think that's going to come until 2024.
Yeah, gold remains in consolidation. I am in the camp where inevitably gold will have a break to an all-time new high and drive a trend higher. I'll agree with that, but I honestly think that it's very reasonable to assume that that won't happen until we have entered some sort of monetary easing cycle. And so it's possible that risk assets generally will do poor for a certain period of time, which will put pressure on gold to stay, trade range bound, or even have a couple liquidity events to the downside. I think almost all opportunities on any dips on gold, I would be a buyer. But I think that if you're waiting for a big gold breakout, it is going to be either late fourth quarter or first quarter. I think there has to be patience here for investors that are pressing this trade. The last thing I wanted to just touch on is the high yield bond market. This is the chart of HYG on page 7. And what's interesting is that in spite of treasury bonds having a very ugly period, surprisingly, high yield bonds were not impacted. They were trade range bound. This caused credit spreads to narrow to 4% area. So the high yield bond market has not yet cracked, and it's certainly not sending any warning signs. But I think increasingly this is the place to watch, because you hear all sorts of people warning that there's credit risks out there. I think that the junk bond market is going to be the one that will advertise it. And while maybe you don't need to directly trade it, it certainly can be used as a canary in a coal mine to see when things have actually pivoted. So we're going to be watching when these break down, and when we, let's say, have high yield credit spreads start clearing 5% on the upside. All these types of things will, in my mind, really signal that some things are turning.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the postgame, and a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That's Erik spelt with a K. And you can also follow me at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.